I think 5 years out, you're talking at least 150,000. So I think, and that could be low end. I really do believe long term that it is the answer. And I think eventually the Fed is going back to printing. Heck, we even saw the Bank of Japan after they talked tough and said, we're not going to do anything. They intervened and actually bought bonds like a day after saying they were going to YCC it, lose the yield curve control. So the Fed will be forced to because of the U.S. debt, and that's the only way is to print more money ultimately and kind of get things started. And that is ultimately the golden ticket for Bitcoin.
Popular technical analyst and chief market strategist of themoneystocks.com, Gareth Soloway has given his mid to long-term price predictions for Bitcoin, the world's largest cryptocurrency by market cap. Unlike Soloway's bearish short-term predictions for the leading crypto asset, his mid to long-term outlook on Bitcoin is quite bullish. According to remarks he made during a recent interview with Kitco News, Soloway expects Bitcoin to be trading at $150,000 per coin within the next 5 years. And that's on the low end. Like every other crypto investor, Soloway expects significant price rallies for Bitcoin sometime between mid-2024 to 2025. It is during this period that the technical analyst expects the U.S. Federal Reserve to start printing again to save the economy after a recession hits sometime early next year. During his discussion with Michelle McElroy, Kitco's lead anchor and editor-in-chief, Soloway says he expects the Federal Reserve to make a move similar to the unscheduled bond buying program recently announced by the Bank of Japan. After sending mixed signals last week by adjusting its yield curve control program, the BOJ has confirmed that it is far from exiting its long-running monetary easing program. During a speech to local business leaders on Wednesday, Bank of Japan Deputy Governor Shinichi Uchida said, "We do not have an exit from monetary easing in mind. The bank's decision to conduct yield curve control with greater flexibility aims at patiently continuing with monetary easing. Given current developments in economic activity and prices in Japan, the bank assesses that there is still a long way to go before such decisions are made." Soloway believes it's only a matter of time before other central banks, including the Federal Reserve, are announcing similar moves, which in the past have proven very bullish for Bitcoin. This time will be no exception, Soloway adds, reiterating that he remains very bullish on the leading crypto asset in the long term. But before that, the technical analyst says Bitcoin has to first cross a few hurdles. We will now bring you clips from Soloway's interview as he discusses his short and long-term outlook on Bitcoin and the overall United States economy. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Thanks for the support and enjoy the video.
At this stage, the regulatory hurdles for Bitcoin at least have been passed, right? We know that recently we heard that Coinbase was asked by the SEC before they filed the lawsuit to stop trading in everything but Bitcoin. So Bitcoin is in the clear for regulatory purposes. But what I'm fearful of, and this is what I think could drive it back down to 15,700 or even lower, is if you get a liquidity issue, right? If you get a issue where the stock market does drop 20 or 30%, that's where I would be very concerned about Bitcoin price holding up. And we've seen it be rejected at this 30 to 31,000 level multiple times. I wouldn't want to see it break 27,000 is this trend line right here. If that gives way, it opens the door, the trap door essentially for us to go back down. And I'll just show this chart here. Let's flip this into two charts here. We have Bitcoin on one side, and I want to bring up the NASDAQ on the other. If we look at the NASDAQ from the all-time highs, right? So here's the NASDAQ. The NASDAQ, I think, is about 10% off of the all-time highs. Bitcoin is massively off the all-time highs, right? We're talking more than 50% off of the all-time highs. And so the idea is if you had the NASDAQ just go back to the October lows, and that's that big of a drop, do we really think that Bitcoin is not going to at least retest that 15,700 level when it's only this small of a drop here? And so I would dare say that if you got a bigger corrective move, if we went into a deeper recession, I do think that Bitcoin could potentially go even as low as my lowest worst case scenario, 9 to 10,000 before bottoming and eventually turning up in a massive way.
Doesn't it seem as though the correlation between the two is drifting?
Well, it still looks like there's a correlation. It's just that, unfortunately, Bitcoin, the interest in Bitcoin has fallen dramatically and institutions are not stepping in versus over here, the NASDAQ clearly has been the recipient of so much money flow. So my fear is, again, is that with less interest in Bitcoin only driving it up this much versus where it was at the all-time highs and so much interest in stocks, if that were to reverse, do you see more panic hitting Bitcoin and driving it back to the lows? I mean, for all we know, maybe the NASDAQ only pulls back to 1250 5, but Bitcoin just alone would then go back to the lows. So I think right now there's still a risk on, risk off correlation there with the stock market, but I do think eventually it changes and becomes the digital gold that we all hope it does. I just don't think we're there yet. People in the crypto industry are way too emotional for us to be back to be at digital gold yet.
But we do also have the potential BlackRock spot ETF coming through, and we have the halving in April.
And I would just say about that too is, interestingly enough, 2007's top on Bitcoin marked the futures launch of Bitcoin. 2021 marked the ETF on the futures, and then the BlackRock news this time on the ETF marked the short-term top. So it's interesting how these news events trigger tops versus what everyone is hoping for is the big breakout. Now, just to be clear, I think the ETF is going to be a game changer. It's going to be a validation of Bitcoin to most retail investors, even older retail investors that don't have any exposure. But I just don't necessarily see that as a short-term catalyst versus the potential for downside via the stock market.
During the interview, Soloway gives his outlook on the U.S. economy, predicting that despite the official lines, a soft landing is completely out of the question. He provides a couple of charts to back up his claim, beginning with one showing a sharp drawdown in the excess savings of households. Over the past year, experts have predicted that the U.S. economy will be able to avoid a recession because of the cash piles households built up during the lockdowns. But these nest eggs are dwindling faster than these experts predict due to the sky-high inflation and high interest rate environment. According to the San Francisco Federal Reserve, U.S. excess savings have fallen to around $500 billion, significantly lower than the $2.1 trillion recorded 2 years ago. The story is similar in Europe, where British households withdrew money from outright savings at a record pace in May, while the government's Office for Budget Responsibility forecasts a savings ratio of 0 by year-end from almost 25% in 2020. Here are more clips from Soloway's discussion with Macquarie.
Data is clear here. I mean, you can see here, and I'll show some other charts of interest. Here's a chart that shows excess household savings. So we see during COVID, there was a massive increase in savings, but look at it getting depleted. And this only goes to about February or March of this year. And you have to think of where we are currently. So you have that aspect fighting kind of this potential for a soft landing. And then you go to something as crazy as this. And this is a really shocking chart for me. This is the median sale price of houses sold versus real median household income. And even in 2008, the cost of a house was about 350 to 400% of income for a family. You're now even well above that level. So talk about a strapped consumer. The data is showing the average car payment is now near $750 versus in 2008 it was about 350 to 400. The cost of housing or the sale of housing is 550 times the median income. These are all things, and again, I'm not even talking about food and energy prices, which now, since the last CPI report in June, have started to catapult higher. So to me, this is just more indicators. And I want to show you a couple other charts because I think I'm a big chart person, as you know.
We know.
But look at this. Look at this. This is the forward PEG ratio, so price to earnings growth. The last time we were this high matches the dot-com era. And again, even higher than 2000 or 2020 or 2008 going into that period. So there is huge speculation. Another chart that I think is astronomically important to take a look at is the aggregate net speculative positioning in U.S. Treasuries. So think about this. Treasuries are now paying 3, 4, 5, 6%, right? I mean, if you go to corporates, you can probably get 6% on something like Microsoft. Otherwise, you're in that 4 to 5% range. Bonds are less attractive to the average investor now. Average investors are saying we are less likely to invest in bonds when they pay 4, 5+% versus stocks now compared to when bonds were paying, 1% or thereabouts. That is crazy speculation to think about, that you can be offered 5% and still say, no, I much rather, even when I was getting 1%, be rather in stocks at this point. And again, it's just remarkable to think about the speculation going on. The last chart I'll show here, corporate bond yield versus Fed funds rate. And I literally could go on with you for 2 hours showing different charts, but to keep it simple, look at this chart. The red line is average corporate bond yield minus Fed funds rate. The white line is the S&P 500. Look at how every time you're down in this range, it coordinates with a major corrective move in the stock market. So again, here, this was the 99-2000 dot-com bubble bursting. S&P collapsed. We know, so did the tech sector. Here's 2007 high pivot. There's your rollover for the Great Recession. There's COVID right there. And look at where we are right now. So all of these signals and then some, to me, just say it's great to think that the Fed somehow, and listen, I love being an optimist. I think people in general should be optimists, but let's be fair. The Federal Reserve has never engineered a soft landing in the history of themselves. What makes us think that this time, when things are even crazier out there, that this time is going to be that situation? Listen, Jerome Powell has said he doesn't mind a recession, but I would just point out this: 2008 in January or February, Ben Bernanke came out and said, guys, we've looked at the data. There's not going to be a recession. What did we get last week? Jerome Powell finally saying, guys, there's not going to be a recession. Again, I think that to me right there is a red flag as well.
Soloway is predicting a mild to moderate recession for the United States economy, primarily because of the Fed's antecedents. They took too much time doing anything about inflation while selling the official narrative that it was only transitory. And now Soloway thinks they will do too much to overcompensate for their past mistakes. He reckons their signs are there already despite the stronger than expected jobs data and recent assurances from Fed Chair Jerome Powell that there won't be a recession. What are your thoughts on Gareth Soloway's Bitcoin price predictions and his outlook on the U.S. economy? Let's have your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more crypto-related videos. Thanks for watching.